Hey, good morning, everyone. Marty Missouri here, September 16th, Monday, 2019. Pre-market update. Going to keep this one quick this morning. Of course, you know, over the weekend, the massive attack on Saudi oil production. Oil, bonds, and gold are up. In terms of bonds, that means yields down. Then, of course, as we should expect, the stock market taking a hit this morning. So in terms of bonds and gold, we've actually both of those were actually getting sold off fairly aggressively over the last week or so, bonds especially. And that would be on somewhat better than expected economic data, the prospects for the Fed not being nearly as dovish as the bulls in those markets might prefer. Of course, it was going to be interesting to see how equity markets treated the Fed meeting announcement. And then, of course, Fed Chair Powell's press conference. Of course, that'll still be what all eyes are watching. The news from Saudi Arabia grows all kinds of uncertainty on top of that. I guess one could argue that that would be inflationary, and the Fed is looking for some inflation. Of course, that wouldn't be the initial thought, overriding thought from the Fed. If indeed this morphs into more geopolitical uncertainty, which I don't know how it couldn't, and heaven forbid if it leads to more military action, and therefore a rising trend in oil prices, the hit that that would do to an economy that, in my view, is already showing some real signs of weakness. And in fact, over the weekend, I was looking at how often recessions are preceded by big spikes in oil prices, and then also just kind of squaring that with Fed action, stock market performance and so forth. I'll probably offer up some of that data over the next few days. Doesn't make you feel real good about the prospects where we are right now in terms of how these asset classes tend to trend right before recessions. I'm not making a prediction. Regular readers, viewers, and clients know where we are with regard to all of that at this point. A year ago, 6 months to a year ago, we thought we were reaching the latter, maybe inflationary stages of the expansion that might have given us a good, 2 years plus to go. That's morphed into something less optimistic, and it's really largely, if not entirely, because of the uncertainty over the trade war with China and potential for trade wars in other places. News item that's kind of flown a bit under the radar since Friday is that the World Trade Organization did decide in the US's favor with regards to subsidies in Europe for Airbus. That opens the door for the US to tariff billions of dollars worth of European imports. And apparently, the U.S. has already compiled its list of what it wants to go after. Many pundits are predicting that that's going to be news that's going to come relatively soon. I'm somewhat skeptical only because I think this administration is getting the message of how negative the market reacts to news of heightened protectionism. So while I think 6 months ago, if we got that ruling, the administration would have jumped all over it. And make no mistake, it may still. In fact, it may very well still. I just don't think that if indeed the administration is concerned with stock market performance and its ultimate impact on the economy and the impact of protectionism on the economy, I got to believe they are thinking twice. I have to believe that the U.S.'s trade advisors are advising the president to not go there at this time. That'll be interesting to see developments with regard to that. So anyway, I promise to keep it quick. Here's your daily chart, bearish wedge pattern. And yesterday afternoon, the S&P futures opened markedly lower, although they're making an attempt here this morning to rally. So here's your daily candle. So again, now that we're below this wedge pattern, we'd be looking for that. Below this trend line, we'd be looking for the S&P to ultimately rally back and test that. What was once support tends to become resistance. So we'll see if that indeed plays out that way. And then on the hourly chart, still, as you can see, remember we talked about this wedge being a place for short-term traders to go long and short within that range there. We were button up against that up in here. Then I think the market waking up to the fact that the Fed may not be all that dovish next. We were seeing the market begin to trade off a bit. And frankly, it would not have surprised me early this week to see this range get tested, if not penetrated. But of course, the the Saudi attack is what did the trick there. You can see from the bottom, the market has been just kind of meandering its way up. You've got your ascending triangle pattern in here, which very well could resolve higher, breakthrough here, and then we've got this resistance up in here that I talked about. So yeah, clearly 2,900 to 3,000 on futures. We'll see what happens when the cash market opens up here in just a few minutes. Drop down in here. Here's that 2980. Here's that roughly 2965 or so on the hourly chart. And again, you get much below 2960, maybe 2950 in here. And then you're down here testing these other levels. Not many things uglier than a failed bullish breakout. So again, folks, lots to talk about. Of course, I'm going to be bugging you like crazy the next few days on the blog, helping you keep it all in what I believe to be its proper perspective. And I'll leave it there for now. Thanks as always for watching and listening. Talk to you soon. Bye-bye.